All right, let's get right into it. Something big just happened with the US dollar, the most important currency on the planet. It took a sudden dive, and in this explainer, we're going to figure out exactly why.
It all comes down to this number, negative 0.96%. Now that might not sound like a huge number, but that was the drop in the US dollar index in a single day on August 22nd. For the world's reserve currency, trust me, a move that sharp, that fast, it's a really big deal, and it gets everyone's attention.
So that really is the central question we're investigating today, isn't it? Why? What on earth could cause such a dramatic shift against the dollar all of a sudden? We're going to break down all the evidence, piece by piece.
So first up, let's just establish what happened here. Because this isn't just some abstract number on a chart. Oh no. This is a signal that sends ripples across the entire global economy. It affects everything from world trade to what you pay for gas.
And here's the absolute key to the whole thing. The market suddenly changed its mind about, well, everything. The trigger was a signal, a really powerful one, that the whole era of high US interest rates, the very thing that's been propping the dollar up, might be ending a lot sooner than anyone thought. And that signal came from one single speech.
And this leads us directly to our prime suspect behind the dollar's big fall, the message that came from the US Federal Reserve, America's central bank. To really get what happened, you kind of have to learn to speak their language. And honestly, that language really just boils down to two words: dovish and hawkish. Think of it like driving a car. A dovish stance is like hitting the accelerator. You're using lower rates to try and speed up the economy. A hawkish stance? Well, that's the brake. You're using higher rates to slow down inflation. Now, the key thing for you to understand is how these two paths directly slam into the value of the dollar. A dovish policy with those lower rates tends to make the currency weaker because global investors just don't get as much bang for their buck. But a hawkish policy with higher rates, it does the exact opposite. It's like a magnet for foreign money, making the currency stronger.
And that is exactly what just happened. There's this big annual meeting for central bankers out in Jackson Hole, and the head of the Fed, Jerome Powell, gave a speech. The market listened to every single word, and the takeaway was a decidedly dovish turn. I mean, traders immediately started placing bets that an interest rate cut was coming, maybe as soon as the very next meeting in September.
Okay, so the market is pretty convinced the Fed is about to hit the accelerator. But why? What are they seeing that makes them so sure? Let's get into the next phase of our investigation and look at the actual clues the market is pointing to justify this huge bet against the dollar.
It all really comes down to three specific pieces of evidence. So we're going to look at each one. The latest numbers on inflation, the return you get on government bonds, and, the level of plain old fear in the market.
So our first clue is something called PCE inflation. Now, you probably hear about the CPI all the time, but the Personal Consumption Expenditures Index, this is the Fed's favorite inflation thermometer. It's the one they really trust when they're making those huge decisions.
And guess what? That thermometer is giving a pretty cool reading. The latest annual number came in at 2.6%. This is a massive deal because it suggests inflation is finally cooling off, which gives the Fed the green light it's been looking for to start cutting interest rates.
Our second clue is bond yields. The simplest way to think about a bond yield is that it's the interest payment you get for lending money to the US government. So when those yields fall, global investors have less reason to buy and hold American dollars. The currency just becomes less attractive. And right after Powell's speech, you guessed it, those yields dipped. And that leads us perfectly into our third clue, fear, or maybe a lack of it. This chart here shows the VIX index, which is basically known as the market's fear gauge. Before the speech, fear was higher. Afterwards, it dropped. This signals what traders call a risk-on mood, where investors feel confident enough to sell the super-safe US dollar to buy riskier things elsewhere in the world.
So, we've gone through the theory, we've looked at the economic clues, but as the big money actually following this narrative, let's move to our final piece of evidence and see how the largest investors are actually placing their bets.
To do that, we look at something called speculator positioning. It's a weekly report that literally shows you the trades being made by huge players like hedge funds. It's like a powerful sneak peek into where the so-called smart money thinks a currency is going next. And just look at this. The data from just before that big drop shows that these large speculators were already net short. In plain English, that means there were way more bets that the dollar would fall than bets it would rise. The big money was already positioned for weakness. Okay, we've laid out the crime scene, we've identified the main suspect, and we've gone through all the clues. So,
The big question is, what should we be watching for now to see if this dollar weakness is going to stick?
Well, here are the critical checkpoints to mark on your calendar. On August 29th, we get that all-important new inflation data. Then in early September, some key reports on the health of the economy. And it all leads up to the main event, September 17th, when the Fed makes its official interest rate decision. Any one of these events could confirm this new trend or reverse it completely.
So if we put this all together, the current outlook among the pros is what you'd call neutral to bearish for the dollar. Traders are keeping a close eye on key price levels around 97.6 and 98.5. But, and this is a big but, there's a risk. If that upcoming inflation data comes in surprisingly strong, all those people betting against the dollar could be forced to buy it back in a hurry. That's called a short squeeze, and it could cause a very sharp rally.
Which leaves us with the final critical question. We've seen all the evidence, a dovish signal from the Fed, inflation that seems to be cooling, and big money betting on a decline. So is this just a temporary blip, a short-term reaction? Or are we actually witnessing the start of a major, long-term shift for the most powerful currency in the world? The data in the coming weeks is going to tell the tale.